All right, as we make our way back to home base, I thought I would talk today about what is PMI and how do I avoid it. If you don't know, PMI is something that you end up having to pay when you buy a home and have a conventional mortgage. PMI stands for Private Mortgage Insurance, and it can be required on a conventional loan where you do not have 20% of the home's loan to value to put down as a down payment. The loan to value is just the percentage of the loan versus the purchase price or value of the home taken as a percentage. It's a real simple formula. Anyway, PMI is actually a premium that you, as the borrower, pays to protect the lender in case you default on your loan. I know that sounds a little kooky. It's insurance that you pay for that doesn't do a damn thing for you. That's basically what it amounts to. It protects the lender in case you default on your loan because you represent a higher risk to the lender when you do not have 20% to put as a down payment on your home. Remember what I've said before, that all lenders, all creditors, all financial institutions are essentially gamblers. That's what they are. And if you don't have money saved up to put as a down payment on your home, then you represent a greater risk to them than somebody that does have money to put as a down payment. Why? Because it shows that they are responsible with their money and their finances and their budgeting and their planning. And you, by not having 20%, aren't. It really is that simple. I hate to be that harsh, but that's the way it goes. Now, PMI can be a one-time fee due at closing on your home, so when you actually close on the mortgage, or it can be a monthly payment. And I obviously am not a huge fan. We had it on our first house, and it was annoying. It was like $100 a month that, in my mind, could have been going to pay down the mortgage itself. The PMI is usually either 0.25% or up to 2% of the loan's value. That's how they calculate the payment for it. So it's either 0.25% or 2%. And I grant you that is a large variance there. And it varies. There's a couple of different forms of it out there, blah, blah, blah. So, to get to the nitty-gritty, on a $100,000 loan, it could be an extra $2,000 a year that you're paying for this PMI, this insurance to protect your lender in case you default on your loan. And it stays in place until you pay your loan down to 78% of the purchase price. Now, thankfully, that 78% of the purchase price means that even if the value of your home has gone down, there could be an end in sight for that PMI payment. Of course, the downer is the way interest is front-loaded on mortgages and whatnot. Before you pay down on pay your total loan down below 80%, it could be 11 years or more on a 30-year mortgage. So something that you definitely want to be mindful of and aware of going into the game. So, and one shining ray of hope is PMI is tax deductible. So, along with your mortgage interest, it is a tax deduction, for what that is worth. Now, how do you avoid PMI is the big question. One of the ways is to have an FHA loan. If you get an FHA loan, there's special rules and things that come into play, and it may help you to avoid having to pay PMI. Another, of course, simpler solution is to actually have 20% to put down on your home. I've talked before about budgeting and how a big purchase should be a line item on your budget. This is what I'm talking about. Usually you'll want to stay in an apartment or whatever other living arrangement you've got for a while until you could save up some money. Now, a portion of the down payment of your home can actually come from a gift. If you've got friends or family that are trying to help you out, so that might take a little of the sting out of trying to save up the full 20%. The downside to that, of course, is that you will indeed have to document where exactly the extra money is coming from. It can't just be pulled out of thin air. The banks and lending institutions take a dim view of that. They want a paper trail on that money. So that's something to keep aware of. One other option that's out there, and you will see it advertised actually, that's how this whole video came to be. My wife came home because she saw an ad or a billboard or something that said 100% financing, no PMI. And she was like, how the heck can they do that? Because we're in our second home, and I was in the mortgage industry for a few years, and so she knows that I know all the ins and outs about this. Well, the answer to that question is usually it's a multi-loan combo. It's a case where you would have multiple mortgages on your home. You would take out a first mortgage for 80% of what you need in order to buy the house, and then you would take out a second mortgage for the other 20%, or possibly a second mortgage and a home equity line of credit. You can see how it gets complicated rather quickly. So that is an option. Now, the trade-off to that, just in case you were thinking, oh, that sounds fine, why didn't you mention that first? Well, the trade-off is that the second mortgage and the home equity line would typically be at a higher interest rate. So then the math starts to get complicated. You've got to do cost-benefit analysis to find out if it's even going to be worthwhile to you, if it's going to save you some money, or if you would have just been better off paying the stinking PMI and going on with yourself. So, something for you to be aware of. It's something that should come up in conversation as you're meeting with your lender, as you're looking at your options. There are things out there, but each one comes with its own caveat and its own pitfalls. So you've got to figure out which exactly is right for you. But as always, guys, if you have questions, if you want to talk about it further, if you're actually in this situation and are looking for, a second opinion, something of that nature, then feel free to hit me up here on Xbox or Twitch. Feel free to send me a message, an email at fustyandfinance@gmail.com. And as always, you can leave it in the comments below the video if you're watching this on YouTube.